Last time on Money from Nothing, money shapes civilization and trust is the foundation. But as societies grew, a critical question emerged. Who should control the purse strings of nations, the people, private bankers, or governments? We're about to see how that question led to historic rivalries, bitter debates, and the creation of entirely new kinds of power, central banks. For centuries, money meant gold or silver in the hand, a solid coin, a bill of exchange. But as trade exploded and America was born, a revolutionary idea took hold. Could there be a single trusted institution to anchor everyone's fortunes? Should the country have a Bank of the United States? Or was this a slippery slope, dangerous concentration of power in the hands of a few? Welcome to the birth of central banking and the American debate that would echo for centuries, right up to the present day. At its core, a central bank is different from your local bank. It doesn't cater to everyday customers or make home loans. Instead, a central bank holds the ultimate banking license. It stores the nation's money, issues currency, sets the rules for other banks, lends to the government, and can influence the whole economy. But how did we get here? And why did so many people then and now think this was a dangerous idea? In the early days, every town might have its own currency, and every merchant could issue an IOU. Banks often failed. People lost life savings overnight. Trade was risky. There was always uncertainty, even fear about which money would still buy bread tomorrow. Powerful merchants, rulers, and eventually governments realized something needed to change. They dreamed of a system that could provide stability, confidence, and control. In 1694, England founded the world's first modern central bank, the Bank of England. It was a government-backed bank designed to sell bonds, borrow money for the state, manage the country's currency, act as the lender of last resort in emergencies. Other European nations soon followed. Central banks helped fund wars, expand empires, and manage massive flows of money. But critics warned, if too much power concentrated in a few hands, entire economies could be manipulated. Would the bank serve the nation or itself? The debate was on. At the birth of the United States, money was a mess. The colonies had issued their own currencies during the Revolution. Most became worthless. The new nation needed economic stability to survive. But how? Alexander Hamilton, first Treasury Secretary, saw what Britain had done. He wanted America to have a strong central bank to support growth, encourage industry and trade, manage national debt, create a stable, respected currency. Thomas Jefferson, Secretary of State, feared the opposite. Central banks would give too much power to a financial elite. Paper money was dangerous. True value should rest in gold, silver, and the output of free farmers and craftsmen. Only Congress should create money, not private bankers. A private central bank issuing the public currency is a greater menace to the liberties of the people than a standing army. Thomas Jefferson. A national debt, if it is not excessive, will be to us a national blessing. Alexander Hamilton. Their personal rivalry became a national battle and still shapes the money debates of today. Hamilton's vision won, at least for a while. In 1791, Congress chartered the first Bank of the United States. It was part public, part private, aiming to stabilize the young nation's currency, manage government debt, and build confidence at home and abroad. But not everyone trusted it. Many feared the bank was too cozy with speculators and foreign investors. Some states wanted their own say over money, resenting any elite institution controlling credit, loans, and trade from afar. The first bank's 20-year charter expired in 1811. Congress was so divided, they just let it lapse. Private interests in state banks filled the vacuum. Chaos returned. With money and trade in crisis after the War of 1812, the government tried again, founding the Second Bank of the United States in 1816. This bank was even bigger. It handled payments for the government, issued notes used throughout America, intended to unite the economy. But old fears returned. Allegations of corruption, favoritism, and shady deals swirled. In the 1830s, President Andrew Jackson threw down the gauntlet. He fiercely opposed any central bank, seeing it as a den of monsters who threatened democracy and liberty. Jackson's fiery words won hearts, and he vetoed the bank's renewal. One of the most dramatic showdowns in U.S. political history ended with the second bank shut down, its charter dead. But with no central anchor, the nation's money supply spun out of control once again. Wildcat banks, frequent panics, lost savings. The free banking era had begun, for better or worse. America's two early central banks showed both the potential and the pitfalls of concentrated financial power. They backed growth and trade, but sometimes served the interests of the wealthy and well-connected. Their existence and destruction changed the fortunes of millions. From Eastern merchants to frontier settlers, the central money problem remained unsolved. How could a vast growing country balance trust, liberty, and prosperity? Who should control the levers of money? Bankers, politicians, or the people? While America fought over centralization, the rest of the world watched or blazed their own trail. Europe's central banks came to quietly dominate trade, empire, and national budgets. Later, Japan, Russia, and dozens of nations followed. A new pattern appeared. When times were good, central banks got praise for creating stability. When crisis hit, they were blamed for hoarding or mishandling power. As the 1800s closed, America was bursting with innovation. Railroads, booming cities, astonishing new wealth. But without a central bank, the nation's finances were dangerously unstable. In the second half of the 19th century, the U.S. suffered repeated banking panics. Without a steady hand at the tiller, banks failed one after another, businesses collapsed, and working families lost savings through no fault of their own. Imagine suddenly finding out your paycheck is worthless, your bank is shutting its doors, and there's no one to help. In 1907, a financial panic swept the country. With no central bank, a handful of private financiers, not the government, stepped in to rescue the banking system. J.P. Morgan, the most powerful banker in America, almost single-handedly stopped total disaster. But should the fate of the U.S. economy really depend on a single private citizen? It was clear to many, America needed a modern answer to the old question. How could the wealth and promise of a giant nation be protected from the chaos of unregulated banks, but without surrendering democracy to a handful of financial elites? These questions set the stage for the creation of something new, a central bank truly American, and yet deeply controversial. That story begins in secret on a mysterious island. In this episode, we saw how the path to central banking was never smooth, and how the arguments of Hamilton and Jefferson still echo in every debate about money, power, and freedom today. We watched a young nation swing between stability and crisis, public and private power, as fortunes rose and fell. Each attempt to master money brought new hope and new controversy. But by the early 20th century, America was ready for a new experiment, one that would forever change the way money, politics, and power worked in the United States and the world. Next time, the dramatic, secretive birth of the Federal Reserve. Who really shaped it? How did a handful of men engineer a solution? And what unintended consequences still haunt us today? Join us for Episode 3, The Federal Reserve Creation and Power, coming soon.